Let's face it, a pro can actually make it look easy. But more often than not, it isn't easy at all. And that's definitely true in the world of finance, especially when it comes to investing for income in the stock market. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services and also the brand ambassador for the Retirement Income Store. When we talk about investing for income on this show, typically we focus on non-stock market options such as individual bonds and bond-like instruments. Now, that does form the foundation of the income model, but the model is not really limited to those more conservative strategies. Investors who have the ability and desire to endure a moderate level of stock market risk can continue to do so while still shifting their strategic focus from growth to income. Specifically, doing it by creating income through dividends. In fact, we devoted an entire show to investing for dividends recently. And today, we're going to take a deeper dive to help you understand how the strategy can fit within a broader income-based portfolio. We'll also demonstrate why, despite a popular misconception, it is a highly specialized approach to stock market investing, requiring just the right resources and the right knowledge. Joining me and my co-host Jeff Small will be financial analyst and commentator Dr. Gary Schilling. We'll also talk to Iowa-based financial advisor Matthew Johnson a bit later in the show. But before we bring on our first guest, let's review a few dividend basics and let's look how a dividend-paying value strategy can decrease some of your stock market risk. Now, as you may already know, dividends are payments that are made to shareholders by companies based upon their profits. When you own dividend-paying stocks, you're receiving a share of the company's profits in the form of a regular dividend payment. Keep in mind, though, that even when investing for dividends rather than capital gains, stocks are generally considered to be riskier than bonds. Why? Because a company can reduce or eliminate dividends at any time. Nevertheless, a high dividend-paying value strategy can still help you lower some of your stock market risk and give you a more practical way to invest in stocks as you approach or enter retirement. This is the approach used by advisors who specialize in income. One reason is that a value strategy involves buying undervalued stocks, which have somewhat less downside risk than the typically overvalued growth stocks that might be comprising your mutual fund or your portfolio today. Another reason is that dividend-paying value stocks really represent a bird-in-the-hand approach to investing. Here's an analogy to help you illustrate what I mean by this. Let's say two different couples decide to invest in real estate. The first couple invests in a plot of land, hoping that its value will appreciate by the time they retire so that they can sell it for a profit. Then, just as they're about to retire, the real estate market experiences a downturn and the value of their land drops significantly. Conversely, let's look at a second couple that decides to invest in rental property. Each month, this couple is able to collect rent from their tenant. Because of that steady income stream, they're much less concerned about the actual property value and the potential of it dropping. The income they receive will help soften the blow of a drop in property values. If they have no need to sell the property at a certain time, they can keep it until the real estate market recovers. And their rental income is going to be coming in either way. It's similar to investing in dividend-paying stocks. If you're retired when the market experiences a downturn, but you have the dividends to help satisfy your income needs, you can hold the stock and wait for the market to come back. Plus, you've reduced the risk of spending down principal to satisfy your income needs. Or, if you don't need the income at any time, you can reinvest those dividends and essentially dollar cost average. You've probably heard me refer to this as growing your money organically, or as I like to say, growing it the old-fashioned way. Now, in addition to all this, stock dividends have tax benefits. Since the dividends these types of stocks pay can increase they can offer also potentially a hedge against inflation. These are just some of the reasons why a high dividend paying value strategy can be a more practical way for those with the right risk tolerance to invest in the stock market once they're in or transitioning to the income stage of financial planning. However, in order to really understand value stocks, you must also understand their counterpart, called growth or momentum stocks. We'll be talking about this more coming up in just a bit. Right now it's time to welcome my good friend and co-host, Jeff Small, President of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also our very own brand ambassador for the Retirement Income Store and Amazon best-selling author of the book, Turning Financial Planning Right Side Up. We also want to bring in our first guest, an income generation virgin, but not a virgin to the industry by any measure, financial analyst and commentator, Dr. Gary Schilling. He's the president of A. Gary Schilling and Company, the editor of A. Gary Schilling's Insight, and author of the book, The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. Dr. Schilling, so good to have you on the show here.
Glad to be with you.
So, you know, we started the year thinking that the markets were going to hit more record highs, things were going well, the economy was going well, and although they did eventually hit record highs, boom, on comes COVID-19, March hits, and everything changed. What was really the most surprising thing to you about how the economy or the markets reacted with this whole COVID-19 crisis?
Well, obviously the virus is the most surprising thing. Nobody really saw that coming. Matter of fact, my wife and I were in Southeast Asia right after Christmas and went through Hong Kong in mid-January. And when we got back, we were worried a little bit about it because, but that was the first time that the virus was really extant. But I think the big surprise was the speed with which this spread and the universality of the whole thing. And also the fact that there is no vaccine. And what we're seeing is that every time economies, cities, states try to open up, return to more normal business and consumer conditions, then you get another wave of the virus and they have to consider locking down and so on and so forth. And of course, one of the problems is that we Americans are not terribly disciplined. It's not like the Chinese where they have ways and some of the European countries, which are much more willing to follow orders.
We're the land of the free and the home of the brave, as I said, and that's a double-edged sword, I guess. But economically, though, as far as the stock market, you probably weren't surprised at the economic carnage in the second quarter. You probably weren't surprised about the, almost 40% market drop in March. But were you surprised about the speed of the recovery versus whether it's economic or just the stock market recovery we've seen so far?
Well, not really, because what we've seen historically is that when you get massive amounts of money dumped into the economy, markets respond. We saw that after the financial crisis in 2008. The Fed went into quantitative easing and stocks took off like a scalded dog, even though the economy had the slowest recovery of any in the entire post-World War II period. So the only thing that investors in stocks are really concerned about is money being pumped out in Washington, and what the basic economy does is much less of concern to them.
Right. Don't fight the Fed. Isn't that right, Jeff?
Don't fight the Fed. Yeah.
Don't fight the Fed.
That's in terms of stocks. That's not in terms of the economy. And of course, the Fed is very frustrated because the Fed can raise and lower interest rates. They can buy and sell securities, and they're buying everything in sight now, obviously, even fallen angels, corporate bonds that previously were investment grade that are now junk. But that doesn't, it's a perennial lead the horse to water, the economic horse, but you can't make them drink. But that has been a little concern to equity investors.
It seems that way, doesn't it, Jeff?
It really does. And, Dr. Schilling, what is of real concern to a lot of investors is what's going to happen with this election and how is that going to affect the markets. And in all fairness, You know, I just found out today that President Trump has the second best stock market as a sitting president since Bill Clinton. Who would have thought on November 6th of 2016, Dow futures were down 800 points, and it's been led by our biggest and brightest companies since that date. What is your take on that?
And Dr. Schilling, we have 30 seconds in this segment.
There's a big difference between investors. Stocks are owned by a relatively small number of people in any size. Yeah, a lot of people have them in their pension fund portfolios and so on, but stock ownership is relatively narrow. And you got a lot of people out there who are obviously out of work on short hours, worried about their jobs, big layoffs continuing. So you have a bifurcated situation in many ways.
And Dr. Schilling, we need to take a commercial break. We want to hear more about that in just a minute. So if you stay with us, we'd love it. And you stay with us too. We have much more coming up from the great mind of Dr. Schilling in just a moment. We'll be right back. As I mentioned earlier, in order to really understand value stocks, you also need to understand their counterpart, growth or what's called momentum stocks. See, when a company has high growth potential, it has the ability to increase its market share in various ways. As a result, it might not pay dividends because it makes more sense to reinvest profits back into the company. Stocks for these companies tend to have higher price to earnings ratios. Often, they're too high, making them overvalued. By contrast, value companies tend to be mature organizations that are still highly profitable, but with fewer internal opportunities for growth than their counterparts. Thus, they typically prefer to pay a higher percentage of their profits out in the form of dividends. As you might have guessed, they also tend to have lower price-to-earnings ratios, making them potentially undervalued, thus the name value stocks. However, as with everything else in the world of business and finance, it's not that simple. Keep in mind that virtually no company can remain mature and highly profitable forever. Eventually, a competitor will come along and cut into those profits. Companies like Woolworth, Montgomery Ward were once market leaders, but eventually they were overtaken by companies like Sears and Kmart. Then those companies were eventually replaced by chains like Target, Marshalls, and Walmart, which now run the risk of being replaced by Amazon. So when a true value investor is deciding which stock represents a good value, he has to ride a knife's edge between dividend-paying companies that are at the beginning of the mature stage versus those that are on the tail end and could be on their way out. And this is one of the biggest challenges facing a dividend-based analyst. See, companies declare dividends in dollars paid per quarter, not in percentages. Therefore, a stock will sometimes appear cheap and boast a high dividend, but that's because it's calculated on a percentage basis, often only because the price of its shares has recently dropped. So it could be at the tail end of its mature stage, where it might eventually have to cut dividends as the price per share continues to drop. Analysts refer to this as something called a value trap. Now, there are many other criteria that go into determining if a dividend-paying stock represents a real value or is a value trap. These include looking for hidden drivers for business growth, drivers that perhaps other analysts aren't factoring into today's price. One example would be takeover potential. Here's the bottom line. Investing for stock dividends is ultimately much more challenging than investing in the stock market for growth, despite a popular misconception that the opposite is true. And again, we'll be talking more about this coming up in just a bit. Right now it's time to bring back my co-host Jeff Small, as well as a new friend to the income generation financial analyst and commentator, Dr. Gary Schilling. So Jeff, at the end there, you were getting the political side of it a little bit, asking some questions. So I'm just going to hand the floor over to you.
Sure, and Dr. Schilling, we got cut off at the break, but I wanted to hear what your take was on why President Trump has had the second best stock market as a sitting president since Bill Clinton in the 90s during the dot-com boom. And we know what the dot-com boom was all about. That was a great time for no matter who the president was, but Bill Clinton had very unique economic policies that facilitated that growth. But why has President Trump, why has he had the second best stock market as a sitting president? What's your take on that? If you could elaborate as to the reasons why, I'd appreciate it.
Well, yeah, as I mentioned in our first segment, I think it's simply because you've had so much monetary and fiscal stimuli coming out of Washington. They've been, dumping money out of helicopters, buying all securities and in sight, all kinds of supplemental income. And of course, it's what's kind of surprising. They haven't gotten together on another round of fiscal stimulus, more money being sent out to individuals, people laid off, et cetera, before the election. But that's what I think is really sustaining it. And you see this just on a daily basis. Whenever it looks like they're going to get together on a new stimulus program, the stocks rise. When there's a delay, stocks fall. That's the only thing that equity investors seem to be concerned about. And the rest of the country is different. Now, of course, it's the rest of the country that elected Trump in 2016. It wasn't the liberal-dominated East and West Coast. It was the people in the center. And those are the people who have been suffering. So that's his constituency. Now, whether that's going to be strong enough to carry him through this time or not remains to be seen.
Yeah, it's going to be interesting to see what happens. I mean, we couldn't trust the polls in 16. We don't know what the polls say today. But for today's talk, we're really going to stay apolitical. But what do you think will happen going forward? Will this election be benign on the markets in 2021? When we see stimulus kick in after the election, because it looks like that's what's going to happen, what is your take on the markets going to be, whether it's a Democratic-driven policy economy or a Republican-driven policy economy? Is that going to be benign? And how's the market in your forecast going to do next year?
Well, you've got issues on both sides. Trump was elected largely on a protectionist policy. He blamed the malaise on immigrants and imports. And if he is reelected, and particularly if he shows any strength in Congress, he probably will go for more protectionist measures, and particularly against China. Now Biden is in the same boat. They're really rivaling to see who can be tougher on China. But the big difference there is that Biden wants to undo all the tax cuts. He wants to increase taxes on the higher income people with assets, redistribute income downward. Basically, it's much more a liberal kind of approach. Now, again, what he would be able to carry out as president is questionable. If I had to flip a coin, I would say that Biden's election would create much more uncertainty for the economy than Trump. Trump, at least, people are used to. Whether you like him or not, you kind of get the feel of how this guy operates and what he does next.
Gee, Dr. Schilling, I've always, reading insights and everything, I've always felt like you were a little bit more left-leaning politically, but it seems now like you're. Am I hearing you right? Sounds like you're coming just slightly more to the right, or am I misinterpreting?
Yeah. Well, you've got. The interesting thing people don't realize is that it's the Electoral College that elects the president. It's not the popular vote, and every state has at least 3 electoral votes. You take Wyoming; they don't have enough population to rank one representative, but the Constitution says they get 1, and they have 2 senators. So population-wise, a state like Wyoming is way under the average, but yet they have a lot more clout, and many of those states in the middle of the country. So the Electoral College, and that's what politicians run for. They don't. Biden isn't going to worry about California or New York. Those are wrapped up. He doesn't worry. Why waste time there? They're going after the battleground states, and there are a lot more of them now than there were in 2016, which makes it obviously a much different election. But bear in mind, in 2016, the popular view, certainly supported by the media, that was Hillary with a shoe-in and Clinton didn't have a chance. I'm sorry, Trump didn't have a chance, but it proved to be quite different.
So, Dr. Schilling, 30 seconds left. Best piece of advice that you have investment-wise through 2021 for people retired or approaching retirement?
I think you need to be very cautious in your investments. Now, we do manage money, and we have a really risk-off portfolio right now. We think that there could be that this recession could stretch into next year. The virus isn't going to go away. And so we are very heavily invested in treasuries, treasury bonds, which have been my favorite since 1981 when I said we're entering the bond rally of a lifetime. And since then, treasury bonds have outperformed the S&P 500 by 6.5 times.
Right. So it sounds like you're expecting a pretty good. Sounds like you're expecting a pretty good pullback on the stock market then, if you're going treasuries.
Yeah, I think the
risk
stock
off.
market is, I think, very expensive and very vulnerable.
Great. Dr. Schilling, we need to leave it there for now. Thanks so much for being on the show. We really appreciate it. It was great having you.
Glad to be of help.
And you stay with us. We have much more to come in a moment right here on the Income Generation. We'll be right back.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.
There are many common myths and misconceptions in the world of finance and the world of investing, and today's show is intended to dispel one of them. I know from my experience that many do-it-yourself investors are under the impression that investing for dividends in the stock market is easier than investing for growth. They think it's as simple as buying a well-known dividend-paying blue-chip stock and collecting the dividend. However, as I hope you're starting to understand, the exact opposite is true. Investing for income in the equity markets can be much more challenging than buying a stock on the upswing and capitalizing on its momentum. In fact, it can actually be pretty easy for someone with a basic understanding of the markets to buy a stock on momentum. Why? Because stocks build momentum and they break through a certain glass ceiling known as a resistance level. It allows investors to jump in and ride the momentum upward. For example, oftentimes you can follow a high-flying stock like an Amazon or an Apple, because if it goes up for a few days in a row, you can buy it and continue to ride it up. And you simply don't sell it until it reverses its trend. If you have the means, you can also use an automated stop-loss order, which is a standing order to sell the stock once it drops below a certain price. That way, if the stock loses momentum, experiences a couple of bad days in a row, it could be sold automatically, allowing you to take your profit. Now, please understand, I don't want to make it sound like this is really simple to do. It's not. But conceptually, it isn't rocket science. The fundamental laws of growth and momentum make it comparatively easier to invest in the stock market using a growth or momentum-based strategy than by using the in-depth analysis required to successfully do value investing for dividends. That's why most advisors take the easy road out, and they keep their clients invested in growth-based strategies, utilizing common stocks and mutual funds, even after those clients have reached the age where income should be their top priority. Being a good dividend-oriented value investor takes not only the ability to identify the difference between a real value and a value trap, but also takes the time and knowledge to go much deeper. Any good investment analysis will gather and analyze the quantitative information that's publicly available about a company. However, that's where most analysts stop. A good dividend-oriented value investor, for that person, it's only the beginning. Because that person then goes on to collect more information and to get insights from industry insiders, as well as the company's investor relations rep. They know exactly the right questions to ask and the right data to gather. And only after analyzing all of it can they decide whether to recommend that stock as part of your high-value dividend-paying portfolio. Even if the average everyday investor had the training and knowledge to do all of this, most wouldn't have the time. Nor do most advisors. So the bottom line is the notion that investing for dividends in the stock market is somehow easier than investing for growth is another one of those financial myths where the exact opposite is actually true. Now it's time to welcome back my good friend and co-host, Jeff Small. So Jeff, anything in particular surprise you that came out of, Dr. Schilling?
Well, Dr. Schilling is an icon. He's been around Wall Street forever. Very prolific at guessing a lot of the Great Depressions, the Energy Depression, the Great Recession of the 70s, the housing collapse, all kinds of stuff he was in on before it happened. But what surprised me the most about him was the fact that he said Joe Biden would be bad for the markets. I did not expect that from him. I mean, that shocked me. How about you?
Well, like I said, I always thought he had slightly more left leanings, and he didn't confirm nor deny that. But yeah, obviously and you could tell by his writings, he's coming a little bit more, at least to the center. But what surprised me the most was, on one hand, he's saying there's a risk-off trade on buying treasuries, which most people are going the other direction. And yet, even though he's saying that, he's saying, essentially, don't fight the Fed. Those are my words, but he's saying that's all the markets really care about. So we know the Fed's going to continue, which means the market should continue to go up if you believe in don't fight the Fed. But yet that risk-off trade he mentioned, treasuries being his favorite asset class right now, kind of surprised me. Those two, I wish we had more time to ask him, because those two just didn't seem to go hand in hand to me. Did you make sense out of that?
Yeah, I did, because he answered that question about the treasuries when you asked him what should the pre-retirees and retirees be doing with their money in the short term. And so I think when he looks at, don't fight the Fed mentality, that's for people who really don't need the money to live off of, and they can afford to take risk. But for the majority of Americans, everyday folks that we work with, they can't afford to take risks because they're not going back to work to accumulate. So they've got to avoid what the next 12 to 18 months looks like economically. And we know that it's going to be a very hard get up from here. Since we've recovered half of the jobs that we've lost, it's going to be twice as hard, if not harder, to recover the other half of the jobs we've lost over the next 12 to 18 months as we battle this virus.
Well, I know from his notes that part of what he's looking at is certainly not fully recovering from the recession until at least the end of 2021. And because the markets are forward-looking, normally 6 months, maybe 9 months. I think what he might be thinking is now the markets essentially are looking forward about 15 months. And is that too far? Are they stretching too far, trying to take too big of a stride across the gap, and maybe they lose their footing and fall in? That's my best guess as to what his thoughts are with taking this conservative approach.
Well, I think you're right about that. But the other thing that kind of surprised me about what he said was he made a comment that his Treasury portfolio since 1981 have outperformed the market. Did he say that?
Well, if you own 30-year Treasuries in 1981 at the peak of interest rates, and interest rates came down, you would have done quite well. But of course, that's that's a once-in-a-lifetime thing. And I don't think rates are going to go right back up anytime soon. I think it's going to be years and years, as you do. But the reality, though, is that was a once-in-a-lifetime bull market for treasuries, and we haven't seen that. The real question, I think, now is how long rates are going to stay near zero, and are they going to go negative? What's the bigger thing that we're fighting? Are we fighting more inflation, or are we fighting more deflation? If you think you're fighting inflation, then you want to buy a bunch of real estate. But I know Dr. Shilling, for example, is really careful right now with real estate. A lot of what he talks about is, residential real estate is going well because of personal reasons, people's personal goals. But as far as all the different types of, let's say, REITs that are out there, whether you're talking about office, whether you're talking about industrial, you're talking about hotels and entertainment, I know from his newsletters that's a big concern of his, real estate in general. So my best guess is he's thinking more deflationary, that might be our biggest thing we're battling, than he is inflationary, which should make sense if he likes treasuries, correct?
Well, it does, but I think the Fed's going to be more successful at fighting deflation than they are trying to create inflation, because we know they can't create inflation. But boy, are they filling the pipes up with credit and money supply and the expansion of our money supply so people can do what? Buy and spend. Lending is happening at a rapid pace right now. That's one of the reasons why real estate is skyrocketing. However, the Fed had said a week or so ago, Dave, that interest rates are going to be at zero through 2023. And that basically sent a signal to the markets that, look, we're not going to raise rates for a long time. We're expecting that the economy is going to take a while, at least 24 months, to get back to where it was. And that assumes we have a decent post-therapeutic or vaccine that can cure the COVID issue, and it doesn't keep lingering on for the next 2 or 3 years.
Yeah, a lot of people are talking about, you're 100% right, a lot of people are talking about, though, concerns about inflation because short-term inflation numbers have crept up. But that's really just, I believe, a lot of pent-up demand. There's lower supply because companies closed down. There's pent-up demand from people being stuck at home for a while. But at the end of the day, the Fed tried to create inflation really for just about a decade, and they barely could create anything. So I tend to agree. I think it's the deflation we've got to be more concerned about at this point. But we have our next guest who's a repeat attendee here for the income generation, Matthew Johnson. Right after the break, we'll find out what Matthew has to say about that. So you stay with us. We have a lot more to come right here on the income generation. We'll be right back. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
Call 866-710-1749 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-710-1749. Online at theretirementinComestore.com.
Now, as we've discussed today, one of the most important and difficult challenges in investing for stock dividends is recognizing the difference between a real value versus a value trap. Here's a quick story to help illustrate that concept more clearly. Years ago, I was in Italy with a friend attending a conference. While there, we came across a vendor selling fake Rolex watches, and my friend Ray decided to buy one. He haggled with the vendor and was able to get the price down from $50 to $20. The watch looked pretty authentic, and Ray thought he'd gotten a great deal for 20 bucks. This seemed like a real value. However, the next morning, when he went to wind the watch, the knob snapped right off. Turns out the vendor was willing to sell it cheap for a reason. It was a nice-looking piece of junk. My friend Ray had stepped into a value trap. And the same thing can happen when it comes to buying certain value stocks. The stock price might be low and the dividend high because the company is contracting or perhaps in a dying industry where the price of its stock could do a slow bleed down to zero. It may seem like a value, but an analyst might expose it as a value trap. On the flip side, I have another friend who bought himself a real Rolex some years ago, but also at a bargain price. It was 2008 during the financial crisis. And because of that, he was able to find a slightly used watch at a huge discount. That watch has worked well for 12 years, and it's worth much more today than what my friend paid for it. And he got enjoyment of it along the way. Obviously, this was a real value, similar to what you get with a real value stock. The ability to enjoy all the dividend income it generates for years, and eventually the ability to sell it, hopefully at a higher price. Let's bring back in my good friend and co-host, Jeff Small. And we also want to bring in another very good friend and our next guest, Matthew Johnson, owner and president of Johnson Wealth and Income Management, a retirement income store located in Humboldt, Iowa. Whew. We got a lot of uncertainty going on there with the stock market, Matthew, right? We got the elections, we got isolationist policies with China, we've got this whole COVID-19 uncertainty. What are you seeing right now are the biggest factors that people in Iowa are concerned about when it comes to the stock market?
When it comes to the stock market, I think that there's still a lot of individuals that are kind of holding their breath. As long as all the stars are aligned and the feds keep everything in place, they're probably okay. But for the most part, I think that there's also a tremendous amount of limit orders out there with people on the trigger, and they're ready to sell if they see volatility or if they see things go the wrong direction.
Jeff?
You know, MJ, we hear a lot from folks, since you're an income specialist, we hear a lot from folks that we visit with for the first time. I've got this common stock. I know it's not doing that great, but hey, it pays a great dividend. And don't you find that people in general don't understand dividends in all senses of dividends, the ones that we create in the safe or more conservative realm of financial advising versus the ones that are maybe more aggressive in common stocks? What type of misunderstandings in dividends do you see up there in Iowa?
I do see a fair bit of that. I see that there's a lot of people that, number one, they'll own some individual stocks. They're the common stocks, they're paying the dividends, and they're not paying attention to the yields. Many of the investors don't even realize that their dividends have been cut to some degree. Some have been eliminated altogether. You look at many of the big large cap corporations, they've got net revenue that's, negative 25, negative 30, negative 40%. And common stock investors typically don't understand that that dividend is not guaranteed. Also, another area that I see that is often misunderstood is the fact that they've got mutual funds, and they might see that they're getting a yield of a dividend, but they don't realize that the dividend isn't actually being paid to them. It's being reinvested back into buying more shares of the mutual fund. And that really has a negative consequence, because when you need the income from a mutual fund, what do you have to do at that point? You have to sell the shares to get the income.
Yeah, most people don't know the difference. I hate to say it, but you ask them what the dividend is, oh, well, I'm getting $2,000 a month. I think that's a dividend, when really, as you say, that is the withdrawal. So I know that, you know, Iowa is a red state. We have a lot of viewers right here on Newsmax from Iowa. So in the minute we have left, you know, how concerned are they? This concept of having a limit order, one finger on the trigger, you think a lot of that's because they're concerned about maybe a blue wave?
I think it could be a little bit of that, but I think that there's a bigger component here. There's a lot of people that are watching what the Federal Reserve is doing, Dave, and they're printing money like a bunch of drunken sailors right now. And people are so afraid of inflation. People in this area, they're rural farmers. They were trying to buy and own ground with mortgages that had 14, 15+% interest rates on them. And so they're looking at the common stock. And even though in some form of their mind, they say, well, the stock market is a good inflation hedge. They know that if the volatility strikes all of a sudden because the feds decide to do something different or the election goes the wrong direction, now they've lost whatever growth they had against that inflation hedge, and that's a concern to them.
So not a lot of modern monetary theorists in Iowa is what I'm hearing you say. We take a quick commercial break. We'll be back in a minute with more to come from Matthew Johnson. I'm David Scranton, and we'll be right back. Welcome back to The Income Generation. I'm David Scranton, here with my co-host Jeff Small and our good friend and guest Matthew Johnson, owner and president of Johnson Wealth and Income Management, a retirement income store located in Iowa. So, what's your crystal ball tell you, Matthew? We get out a year, maybe a year and a half, and we're past the COVID-19 crisis, perhaps herd immunity, vaccine, whatever gets us there. How do you think the economy and the financial markets will have changed?
Well, that's a good question. I wish I knew the exact answer to that. But right now, there's a lot of, I would say, mindset that is very dismissive over so many different things. People are so sick of COVID-19, the topic of it, the talk about it. They're so disenchanted with the elections right now. There is kind of this dismissive mindset where they're just going to continue to go back to the old ways of doing things. And yet I see that there's this undercurrent of being very, very guarded because they understand that there's so many things that are beyond their control, and they know that they can control their money. They can control where their money is invested. I would say as long as the Federal Reserve continues to stick to their guns in monetary easing, that things will be somewhat steady. But I honestly do not see a tremendous amount of growth like so many analysts are suggesting we're going to have, because there is a lot of recovery that is having to be recaptured from all the losses. This was the greatest contraction we have ever seen economically in the last, 75, 80 years. It's pretty profound.
And the quickest, too. The greatest and the quickest. Isn't that right, Jeff?
Really is. And so now we're on the topic of the greatest things, and this has been a crazy year, greatest correction, shortest correction in history, fastest recovery. Half the employees that we've lost are back to work, but now the economy's facing headwinds. So what opportunities should investors and pre-retirees in, let's say, the 55 plus space be concerned about right now? What's going to be the good things they should be looking at versus the bad things in terms of the philosophical positioning of their money? How do they invest today, MJ? What do they do?
There's a couple of thoughts there. The first is, the old cliche phrase, if it happens once, shame on you. If it happens twice, shame on me. This is a good reminder of just how volatile the stock market can be in times of uncertainty. And it's always been that way, right? So investors that are to the age of distribution, the age where they need to be more conservative and they need to be focusing on income, I think it's a perfect opportunity to take winnings off the table. What are you going to do with those winnings? Well, I think that this gives you an opportunity for true diversification. Number one, start being able to work with a fiduciary who knows fixed income to make your principal safer and get it to produce 2 to 3 times the income that it has under common stock and mutual funds. Number two, really look for some of those good quality common stocks that are paying a higher than average dividend, and make certain that someone's really doing the analysis and that they're fundamentally sound companies.
That's great advice. Yeah, I think there's a huge emphasis today in opportunities that folks can afford to in the value stock realm, where we've got good dividends, stocks that are still underpriced based on that correction. They're going to still come back. And if COVID ends up being a 2020 event and not a 2021 event, those stocks will appreciate when that happens and we transition out of this.
Absolutely.
You know, it's interesting. I want to ask you, Matthew, you know, we know that you can have a very healthy, robust, value-based, dividend-oriented stock portfolio that might pay a 4 or 5% dividend. But yet it seems like we never see that. It seems like most of the stock portfolios we see that traditional advisors utilize, or mutual fund portfolios, maybe pay a 2.5% dividend, and that's it. Why do you think we don't see it more? Is it just because, like we talked about on today's show, it's more difficult to invest in value-oriented, high dividend strategies than it is just to ride growth and momentum upward?
Well, I think a lot of it has to do with the business model, right? So when you're working with a franchise, let's say, or you're dealing with a traditional brokerage, wholesaler, something of that nature, most of those brokers are only going to be pushing or suggesting the types of positions that their firm has realized to be on the safe side or to be on the popular side. It takes a great deal of due diligence. You know this as well as I do, Dave. When you're in fixed income or you're looking for value stocks that have good dividends, it takes a lot of good old-fashioned elbow grease. And the time, the energy, that's all money.
I think it's perhaps why I love coming to visit you so much in Iowa, because farmers aren't afraid of hard work. But unfortunately, I think today's generation of financial advisors often is taking the easy way out with ETFs and mutual funds and so on. So 15 seconds. Final words of wisdom for our income generation members.
Do not forget to learn lessons from the lessons learned of previous generations and what's happening around us today. This is not pie in the sky. This is not just random, whatever happens, happens. What happens to your money is a direct result of the decisions that you make. And there may be some really good alternatives to be able to explore with your money that will give you a greater chance of success in retirement.
And history repeats itself for a reason. Matthew, it's been our pleasure as usual. Thank you so much for being here with us.
Thanks, Dave.
And you stay with us too. We'll be back here with more in a moment on the income generation. We'll be right back. I'd like to thank my guest, Dr. Gary Schilling, as well as Matthew Johnson, as well as my good friend and co-host, Jeff Small, for joining me today on The Income Generation. But I also want to thank you, our new and returning viewers. Some people like risk more than others, and that's true when it comes to life, and it's true when it comes to investing. While one of the most fundamental goals of investing for income is to reduce your risk once you're in or nearing retirement, investing for income doesn't necessarily mean you need to abandon the stock market. That is certainly still an option. Many investors over the age of 50 enjoy competitive returns in the form of income, with portfolios built entirely around bonds and bond-like instruments with little real stock market risk at all. However, for those with a higher risk tolerance, you can stay in the stock market game, but still shift your strategic focus from growth to income using a high dividend value strategy. For the right investor, it can be a more practical approach to staying in the equity markets after the age of 50, and that's for several reasons. It's a strategy that focuses on undervalued stocks, which may carry less downside potential than the overvalued stocks in a typical growth-based strategy. It's also a bird-in-the-hand approach that creates a reliable income stream. This income stream helps minimize your concerns about market growth or market shrinkage. It gives you a more practical way to dollar cost average after the age of 50 by reinvesting the dividends you don't need for income to grow your portfolio organically. Perhaps the most important thing to remember from today's show, however, is this. Successfully investing for income in the stock market can be much more challenging in many ways than investing for growth, despite the misconception that it's easier. Being a good dividend-oriented value investor requires the specialized ability to spot the difference between a real value and a value trap. It takes time and knowledge to go much deeper than most growth-based analysts and to examine a wealth of data most investors and even most advisors simply don't have access to. Only an advisor who specializes in retirement income is likely to have access to this kind of specialized knowledge. It's the kind needed to help you shift your strategic focus to where it should be once you're in or nearing retirement, and that is income. As always, stay safe and thanks for watching. If you're close to or in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.